Okay, let's talk about the financial markets and the economy. We're going to start with the informational role that is involved in the financial markets and the economy. And of course, capital flows to companies with the best prospects. There's no shortage of information on financial markets or companies. And so the information that flows to the investors through things like Bloomberg and CNBC on television, plus the plethora of websites that are on the web, this impacts the markets and the economy. For example, when Apple came out with the iPhone, BlackBerry stock started to fall, so capital was flowing out of BlackBerry and flowing into Apple, and that of course has continued because Apple's prospects kept getting better. So we see the informational role has an impact on who's working, who's not working, the flow of capital coming into the country, coming out of the country. This is a very important fact of the relationship between the markets and the economy. We can also think of the financial markets with regard to consumption timing. So financial markets allow you to buy and use securities to store wealth. You can do it with bonds or stocks, things like that, and you store your wealth and then you transfer the consumption to the future. So instead of buying a building or buying a real asset, financial markets or financial assets allow you to store your wealth and hold it for the future. So many of you probably already have a 401k or an IRA, and so you're storing up your future or you're storing up your current wealth so you can have future consumption and spend it in the future. And in between now and then, you're hoping that the amount of wealth that you have, the amount of money that you have, will go up. So financial markets allow consumption timing so you don't have to consume it all today. You can consume some things in the future because you allow securities or invest in securities. There's another aspect with the allocation of risk. Now, risk I will mention quite often as being very, very important. Risk is more important, in my opinion, this is my opinion, than reward is when you're thinking about an investment. I would always start with the risk. What kind of risk do I want to take? And is this a good risk and reward trade off? So investors can select securities consistent with their taste for risk. You can take a lot of risk or you can take little risk. And so that benefits the firms that need to raise capital as a security because they can be sold for the best possible price. So if you're out there trying to raise capital for your firm and you are a very low risk firm, then you don't have to spend as much or give as much return to your investors as you would if all of the prices for risk were the same. Conversely, of course, if you're very risky, say a biotech company in trying to find a cure for cancer, then you're going to have to provide a great risk and reward relationship to your investor to entice them to invest in your company and hopefully your future cure for something that seems to be very challenging for us. And so when you think of risk and reward relationships, the financial markets allow this allocation of risk because you can choose between a high risk and a low risk security, and it's very easy to move between the two. Also, the financial markets get into the separation of ownership and management. Now, this causes a thing that you've probably already talked about in some of your classes, which is the agency problem. In other words, we hire someone else to do something for us, and of course, there's a cost associated to that because no one does the job that you will. And you know in your own life, if you cut your own lawn, you would do a better job than somebody else because you care more about your lawn than anyone else. And this is true for a lot of things in our lives. Well, in the case of financial markets, in specifically corporations, we hire CEOs and other managers to handle the situation for us, to manage the company for us. And in doing so, we have a agency problem in that they might be maximizing their own interests instead of maximizing our firm's value or our shareholders' value. So when we start thinking about agency problems, we start to think to ourselves, would that CEO really be trying to just feather his own nest, or is he really hard at work trying to make me more money? Well, it doesn't take long for anyone to figure out that there's probably a little bit of both in all the companies out there, some worse than others. Now, ways to overcome that: the first thing is you can tie the manager's income to the success of the firm or stock options. So, in other words, the CEO's compensation would be some sort of small salary, and then mostly based on how the stock performs or how the shareholders perform in the future. Now, this aligns the goals of the shareholder with the owner or with the CEO or the manager. And so that alignment, the better it's aligned, usually the lower the agency costs. We can also monitor the board of directors. The board of directors is supposed to be representing the shareholders. And we can monitor from the large outside investors and security analysts. So a large outside investor such as TIAA, CREF, or a security analyst like a Goldman Sachs or JP Morgan, or more importantly, an independent security analyst that isn't in the business of issuing stocks or bonds, we could look at their monitoring and use them as a proxy to see if we're mitigating the agency problems. And of course, we could have a takeover threat. So takeover threats allow or force companies to make sure that they're running in a way that doesn't allow other companies to see that their stock is tremendously underpriced, or that there's something that they could take advantage of. So that somewhat mitigates the ownership and management agency problem. Another thing we need to talk about a little bit is the corporate governance and corporate ethics. So we just had a huge scandal in Wells Fargo here, and 5,000 people lost their jobs, and it was corporate ethics and corporate governance at its worst. And there really was no penalty for anyone, and it was a very sad day for everyone involved. And it was just a failure, and we can talk about it more online, but it was really bad. And of course, there are plenty of other accounting or corporate governance ethics issues out there. So Enron, Rite Aid, HealthSouth. So when you start thinking of these, you look for who is supposed to be watching this. The first one you think of is the auditor. The auditor is an external, usually accounting firm, that comes in and reviews the books and makes sure that you're not cheating and you're not, the numbers add up the way they're supposed to add up and so on. They are supposed to be the watchdogs of the firm. Well, the auditor, Arthur Andersen, was a watchdog of a firm right up until it got caught not being a watchdog of the firm, but being a profiter from not watching the firm. And so they are no longer in business. And of course, that led in many respects to the Sarbanes-Oxley Act to tighten the rules of corporate governance. And since then, we've had a plethora of paperwork, some of which some people believe that hasn't been totally helpful. In addition to that, there's been quite a bit of extra work to do, which some people feel is somewhat wasted. But nevertheless, this corporate governance and corporate ethics is definitely a problem for us currently, and it will be in the foreseeable future, because the amount of money that's involved is very tempting for most people, and therefore we have to keep a constant eye on our corporations and their ethics and governance, because it's just so tempting to take those big paydays when you can get them.